For centuries, a repeating pattern has taken down every dominant global currency without exception. Not most of them, all of them. The Portuguese real governed long-distance trade for nearly 8 decades before fading. The Dutch guilder shaped commerce for a similar span, and then declined. The British pound held the position for just over a century until it lost the throne. Each of these currencies followed the same set of phases, each convinced it was immune to past outcomes, each assuming permanence, and each eventually proven wrong. The United States dollar entered the role of primary reserve currency in 1944. That places it at roughly 80 years in this position, and as of 2025, it sits in the 5th phase of the same cycle that ended its predecessors. This is not speculation or superstition. It is a mathematical progression that has unfolded repeatedly over 600 years. The real question is whether we can recognize what is happening, or whether we believe the familiar story that this time the rules no longer apply. Before exploring the stages, it is important to understand what a reserve currency truly is. It is more than a strong currency or a symbol of national power. A reserve currency is the form of money other nations stockpile in their central banks. It is the unit in which global commodities are priced. It is the standard used to settle trade between nations that do not use the same money. When a currency becomes the reserve, every country must hold and use it. To purchase oil, they require that currency. To correct trade imbalances, they require that currency. To invest in safe assets, they accumulate the bonds issued by the reserve currency nation. This creates what economists call an extraordinary privilege. The issuing nation can create additional currency and exchange it for tangible goods from around the world. Other nations must produce goods to acquire the reserve currency, while the issuer can simply expand its supply. The reserve currency nation can run continuous trade deficits because the world needs its money. It can borrow at lower rates because global demand for its bonds is built into the system itself, not based on preference but necessity. Becoming the reserve currency is the greatest financial advantage an empire can hold. It is also the reason earlier empires fought to gain that position, and why they suffered when it slipped away. The journey always starts the same. Phase 1 involves military power strong enough to command vital trade pathways. Not just possessing a powerful navy or army, but controlling the routes through which global commerce flows. In the mid-15th century, Portugal became the first example of this pattern. They achieved something no other European state had mastered at the time, the ability to navigate the open ocean with precision. While most ships stayed close to familiar coastlines, Portuguese crews ventured across vast stretches of water. When they passed the Cape of Good Hope in 1488, they uncovered a sea route to Asia that avoided the land routes controlled by the Ottoman Empire. This was not only a geographic breakthrough, it became the backbone of a military trade network. Portuguese fleets armed their ships heavily and enforced dominance across the Indian Ocean, the South China Sea, and the Atlantic. They built fortified trading hubs at crucial maritime choke points, including Goa, Malacca, Mozambique, and Macau. These locations were not simple ports. They were military positions equipped to decide who traded, on what terms, and at what cost. Anyone seeking spices from the islands of Southeast Asia had no choice but to work through Portuguese power. Anyone wishing to trade with India required Portuguese approval. Fees, taxes, or outright confiscation met those who tried bypassing Portuguese oversight. This dominance meant that merchants needed Portuguese currency to operate in the growing network of controlled waters. The real became a default currency for global exchange, not because of its intrinsic economic strengths, but because it was reinforced by Portuguese firepower. The Dutch repeated this process during the 17th century. Their East India Company was not simply a commercial group, it acted as a hybrid entity with its own military forces. At its height, it commanded fleets of warships and tens of thousands of armed personnel. The Dutch seized former Portuguese assets, took control of spice-producing regions, and turned Amsterdam into the central marketplace of world trade. Their fleets held influence across the Baltic, the Atlantic, and the Indian Ocean. As a result, the guilder became the logical currency for trade, moving through Dutch-managed waters and markets. Britain took the model even further in the 19th century. Its navy became the most dominant in the world, larger than several competing fleets combined. Control of the Suez Canal, Singapore, Gibraltar, and other important maritime gateways gave Britain command over trade movement between continents. This made the British pound the currency required for most global exchange. After the Second World War, the United States achieved the same dominance. Their navy operated in every major ocean with unmatched reach. Strategic bases near critical maritime passages meant that the world's shipping routes functioned under American oversight. This placed the dollar in the same first phase of the long historical pattern. This brings us to the second phase, the period of expanding wealth through trade surpluses. Once a nation commands trade routes, the next development is almost automatic. Wealth begins flowing inward at a scale the rest of the world cannot match. This second phase shows up in every historical cycle, and it always begins as a period of extraordinary prosperity. Portugal experienced this first. Throughout the 16th century, they brought back valuable goods from Asian markets, such as spices, fine textiles, and porcelain. These goods were purchased with gold and silver, yet sold in Europe at massive markups. The price differences created large surpluses that concentrated wealth in Lisbon. Ships returned full, and the margins were so huge that the crown could finance its government largely from overseas profits rather than domestic taxation. Lisbon grew into one of the richest capitals of its era, supported by consistent inflows of high-value products. The Dutch surpassed even this. In the 17th century, Amsterdam became the global warehouse. Goods from across the world moved through Dutch hands. They purchased cheaply in one region and sold at significantly higher prices in another. Their strategy was not only trade but global-scale arbitrage. Amsterdam prospered as canals lined with elegant homes filled with merchants whose personal wealth rivaled that of nobility elsewhere. The Dutch surplus became one of the most notable in early modern history, built on the combination of shipping efficiency, military protection, and disciplined commerce. Britain elevated the model during the 19th century. It produced a vast range of manufactured goods, from ships and machinery to textiles and steel. These exports were sold across the world, while Britain imported raw materials at low prices, often dictated by British buyers. The earnings from manufactured exports were so large that London emerged as the world's financial capital, managing enormous volumes of international capital. The wealth generated during the surplus phase shaped Britain into the preeminent economic power of its time. The United States experienced the most dramatic version of this pattern after the Second World War. By 1945, Europe and Asia were devastated, and American industry stood almost untouched. Factories, infrastructure, and production lines were ready to supply the world with machinery, vehicles, steel, and consumer goods. As nations rebuilt, they depended on American products, producing massive trade surpluses for the U.S. jet. Dollars accumulated in foreign banks faster than they could be recycled. The U.S. gold supply ballooned, with Fort Knox holding more gold than the rest of the world, combined during the 1950s. This period created unprecedented prosperity, but history shows that the surplus phase never lasts indefinitely. All reserve currency nations eventually move from producing more than they consume to consuming more than they produce. This marks the shift toward the third and fourth phases, where the advantage begins to reverse. As the wealth from long trade surpluses accumulates, the world eventually formalizes what has already become true in practice. This is the third phase, where the dominant currency is officially recognized as the global reserve. It represents the peak of power, but it also marks the moment when decline begins to take shape beneath the surface. Portugal reached this point in the early 16th century. Merchants and governments across Europe and parts of Asia began writing agreements and trade contracts denominated in the real. The currency's role was no longer informal or based solely on control of trade routes. It had become the accepted standard for international exchange. The Dutch reached this formalization in the mid-17th century. The guilder became the preferred unit for bills of exchange and financial contracts. Even major trading powers such as the British East India Company found it practical to use guilders in some circumstances, since Amsterdam offered the deepest and most liquid financial markets of the era. The guilder's reserve role strengthened as Dutch banking and trade dominated the economic order. For Britain, international acceptance arrived after the defeat of Napoleon in 1815. At the Congress of Vienna, major nations recognized the pound sterling as the global benchmark. Loans, treaties, and large-scale trade were often set in pounds. The gold standard that developed during the 19th century functioned largely as a pound-based system, since Britain held the most influence over its rules and operations. This pattern repeated in 1944, when representatives from dozens of countries met in New Hampshire. The agreement they signed placed the dollar at the center of the global monetary system. Other currencies were tied to the dollar, while the dollar was tied to gold at a fixed price. This arrangement created international institutions to oversee global finance and embedded the dollar as the foundation of world trade. No previous reserve currency had been established with such formal structure and broad agreement. Yet this moment of maximum authority carries a built-in weakness. Once the world needs more of the reserve currency to conduct trade than the issuing nation can supply through exports, the system changes. Instead of exporting goods, the reserve nation must export its currency. This produces permanent trade deficits. The economist Robert Triffin explained this in the 20th century. To supply the world with enough reserve currency, the issuing country must send more of it abroad than it receives. This forces the nation into a long-term imbalance. Every reserve currency has faced this problem, and none have escaped it. What appears to be the peak of stability is actually the start of strain that leads toward the fourth phase, the era of deficits and growing dependence on past wealth rather than new production. The fourth phase begins quietly, almost unnoticed by the people living through it. A reserve currency nation moves from producing wealth to consuming the wealth it accumulated during its rise. The symptoms appear gradually at first. Portugal reached this stage in the mid-16th century. After decades of strong surpluses, the kingdom began relying heavily on imported grain, manufactured goods, and textiles. Gold and silver from colonies in Brazil and Africa financed these purchases, but the country was no longer creating value at the same pace. Spending by the crown increased, funding palaces, military ventures, and a growing administrative network. The inflow of precious metals masked the weakness beneath the surface. As long as ships continued arriving with bullion, it seemed the prosperity could continue forever. But the nation was no longer building new productive capacity. It was consuming the riches of earlier successes. The Dutch followed an almost identical trajectory in the 18th century. After achieving remarkable prosperity during their golden age, they grew comfortable living off accumulated capital. Instead of expanding industry, they shifted increasingly toward financial activities. Dutch investors lent money across Europe, generating steady returns, but this income came from capital rather than from new production. Factories stagnated, and the once dominant trading fleets faced rising competition. The trade balance reversed, leaving the Dutch importing more than they exported. The wealth that had taken generations to accumulate slowly drained away to support a lifestyle that no longer matched the nation's productive output. Britain entered this stage in the early 20th century. After pioneering industrialization, British manufacturing began losing ground to faster-growing economies like the United States and Germany. Goods that Britain once exported now arrived from foreign producers. The nation's vast investment portfolio across its empire produced large streams of income, but this income also reflected past success, not present vitality. Britain financed a growing portion of its needs through this external income rather than domestic production. Trade deficits expanded, signaling the shift from wealth creation to wealth consumption. The United States crossed into this phase unmistakably in 1971. That year marked a permanent reversal of the trade balance. The country moved from surplus to deficit and never returned to surplus again. By the 1980s and 1990s, the deficit widened consistently, and by the early 21st century, it became the largest in history. The nation imported far more consumer goods, machinery, textiles, and electronics than it produced. Yet the deficits posed no immediate barrier because the world needed dollars. The United States could simply create currency and exchange it for real goods from abroad. This ability offered comfort, but it also encouraged long-term imbalance. As with earlier reserve powers, the fourth phase sets the stage for the next. When deficits become too large to sustain without altering the currency itself, the fifth phase emerges when deficits can no longer be managed through ordinary borrowing. At this point, every reserve currency nation turns toward altering the value of its money. This is the stage of currency dilution, the period when the issuing nation prints or expands its currency supply, because it cannot fund its obligations otherwise. Portugal encountered this problem first. As revenues from global trade weakened in the mid-16th century, the ruling government needed more money to maintain its empire and cover rising expenses. Instead of reducing spending or raising taxes, they altered the currency itself. The silver content of the real declined as the crown issued more coins with less precious metal inside. Merchants noticed that the purchasing power of the real no longer matched its face value. Prices rose and confidence weakened. By the 1570s, many traders avoided the real, unless adjusted for its slipping value. indicating that the currency had entered a stage of growing distrust. The Dutch reached this point in the 18th century. Their government took on rising levels of debt to finance wars and maintain their diminishing influence abroad. As borrowing costs climbed, they began issuing more currency to fill the gap. What had once been one of the most stable monetary systems in Europe became vulnerable. The guilder's value eroded, and global traders began using alternative currencies for major transactions. By the 1780s, the guilder's role in international trade had diminished sharply, showing how currency expansion undermines confidence. Britain faced its own era of dilution during the 20th century. The First World War forced the nation to print money far beyond its gold backing, and the return to a fixed gold value in the 1920s caused significant strain. When the Second World War began, Britain abandoned the gold standard entirely. The government expanded the money supply to support wartime needs and post-war reconstruction. The pound dropped in value several times, including major devaluations in 1949 and 1967. Each adjustment reduced the confidence of foreign holders and signaled that the pound could no longer function as a stable global store of value. The United States reached this phase in the modern era. The financial crisis of 2008 prompted massive intervention. The central bank created trillions of dollars to stabilize the economy. Then the global health crisis of 2020 led to even larger expansions, pushing the money supply to levels unparalleled in American history. This growth in currency supply diminished the purchasing power of the dollar, contributing to the highest inflation rates in decades. The scale was global because the dollar sits at the center of world finance. When the United States creates new currency, the entire world feels the effects. With confidence weakening, the next step in the pattern appears. When nations holding the reserve currency begin seeking alternatives, the system enters the sixth phase, the early stage of departure. The sixth phase begins when global trust starts to weaken. This shift does not happen suddenly. It begins with small decisions made quietly by central banks, trade partners, and major economies. Over time, those decisions accumulate until it becomes clear that confidence in the reserve currency is no longer stable. Portugal experienced this in the late 16th century. As the real lost its reliability, merchants in Europe and Asia preferred alternative coins with more predictable metal content. Spanish silver and Venetian currency became more desirable, and contracts that once relied on the real shifted toward sturdier options. By the time Portugal fell under Spanish control in 1580, the real had already lost its standing. The political change simply revealed what markets had been signaling for years. The Dutch encountered a similar unraveling. During the 18th century, other European powers slowly reduced their dependence on the guilder. Financial markets in London grew stronger, while Amsterdam weakened. As nations transferred their reserves elsewhere, the guilder became a regional currency rather than a global one. The transition was calm, gradual, and irreversible. Britain's loss of confidence occurred far more rapidly after the Second World War. The costs of war were enormous, and the pound stood on unstable ground. When Britain devalued its currency by a large percentage in 1949, international holders saw a significant portion of their wealth vanish instantly. The result was a sharp decline in trust. Nations shifted to the dollar, which was supported by gold reserves and a strong post-war economy. Within a decade and a half, the pound's role in global reserves had collapsed, replaced by the American dollar. Today, the dollar has entered the early stage of this sixth phase. Signs are visible across the international landscape. Several large nations have reduced their holdings of US debt and increased their reserves of gold. Some have begun settling trade in their own currencies or in alternatives to the dollar. Cooperative groups of nations have discussed building new monetary frameworks that limit their reliance on US-controlled systems. Even countries that have long been aligned with the dollar have started incorporating small but meaningful changes in how they conduct trade. These shifts do not signal immediate collapse, but they do reveal a slow and deliberate movement away from total dependence on the dollar. The underlying reason mirrors earlier cycles. When a reserve currency undergoes extended dilution and persistent deficits, confidence naturally declines. Nations holding that currency begin protecting themselves from future instability. Once this trend begins, it rarely reverses. The world gradually prepares for the final phase, when a new monetary structure emerges and the reserve currency of the previous era loses its central role. The seventh phase is the final turning point, the period when a new monetary center rises and the old reserve currency loses its role. This shift does not always happen through formal agreements. More often, it unfolds through market behavior, as traders, lenders, and central banks gradually choose a different currency for stability and settlement. The pattern has repeated for centuries. The Portuguese real lost its prominence as Spanish silver became the dominant medium of exchange. Spain's access to massive silver mines in the Americas allowed it to mint a consistent and abundant supply of coins. These coins circulated widely, accepted across Europe, the Middle East, Asia, and the Americas. The real simply could not compete with the scale and reliability of Spanish currency, and within a few decades it faded from international use. The Dutch transition was marked by the rise of Britain. As British manufacturing expanded and London became the world's leading financial center, the pound emerged as the new standard. The guilder remained in circulation, but its influence diminished steadily. By the early 19th century, the pound had replaced it almost entirely in global trade and finance. The shift was not sudden, but came from the growing economic weight behind the British currency. The British pound later lost its standing to the dollar after the Second World War. The economic devastation in Europe contrasted sharply with the relative strength of the United States. With major industries intact and immense gold reserves, the United States held the only currency capable of supporting a new global order. International institutions formed after the war reinforced the dollar's role. As Britain faced devaluations and heavy debt, the pound lost what remained of its global influence. By the late 1960s, the transition to the dollar was complete. Today's world has not yet entered the final part of this seventh phase, but the early groundwork is forming. No single currency currently meets all the conditions required to replace the dollar. Some nations possess strong manufacturing, but lack open financial systems. Others have deep financial markets, but lack unified direction. Gold has regained prominence as a reserve asset, but it cannot support the full scale of modern global trade on its own. There are discussions of blended systems that combine several major currencies or use new digital frameworks. None are fully developed, but they illustrate a growing search for alternatives. In earlier centuries, these transitions were disruptive, mainly for the regions tied to the collapse in currency. The next transition, whenever it arrives, will be larger in scale because the dollar reaches into every global market. The coming change will reshape financial systems worldwide, not just within the issuing nation. This seventh phase becomes a test of preparation, as those who see the shift early position themselves more securely than those who assume the existing order will last forever. When a reserve currency declines, the consequences reach far beyond government budgets or financial institutions. Ordinary people experience the effects most directly. This has been true in every historical cycle. When the Portuguese system weakened in the late 16th century, merchants and families holding the real saw their purchasing power deteriorate. Goods became more expensive, contracts denominated in the real lost value, and fortunes built over decades evaporated. The Dutch public faced similar hardship during their decline. As confidence in the guilder faded, savings held in that currency eroded. Investments that once felt secure no longer protected wealth. The decline was not dramatic in a single moment, but it created a long period of stagnation that affected everyday life in Amsterdam and other Dutch cities. Britain's decline brought even more visible effects. After the Second World War, repeated devaluations of the pound made imported goods costlier and reduced the value of pensions and savings. Households saw the real value of their income decline, and the purchasing power of the pound fell steadily. The shift from global reserve status to regional currency affected almost every aspect of life. Wealth measured in pounds simply did not stretch as far as it once had, leaving many citizens struggling to maintain their standard of living. A similar process has been happening slowly in the United States. Over the past several decades, the dollar's purchasing power has declined as the currency supply expanded. The erosion accelerated during major financial crises when vast amounts of new dollars entered circulation. Prices rose while wages struggled to keep pace. Everyday expenses such as housing, food, energy, and healthcare increased significantly. For many households, savings held in dollars lost value even without any direct financial loss. The currency itself bought less cash. This is one of the quiet signals of a reserve currency in the later stages of decline. The impact is not limited to individuals. Businesses holding dollar-denominated assets face vulnerabilities during periods of rapid inflation. Corporations relying on imported goods encounter rising costs, while those operating globally must adapt to shifting currency preferences. Governments holding dollar reserves experience reductions in the value of their foreign assets. All these changes contribute to growing uncertainty, prompting nations and investors to explore alternatives. This stage also encourages people to diversify their assets. Throughout history, those who recognized the pattern early shifted their wealth into more stable forms. Portuguese traders sought Spanish silver. Dutch bankers moved capital to London. British investors repositioned into dollar-based assets after the war. In each case, those who shifted early protected their savings. Those who failed to adapt experienced the hardest losses. Understanding this pattern today offers individuals and institutions the same opportunity to prepare before the final transition accelerates. The complete pattern of reserve currency rise and decline has repeated across centuries, and the timeline for each cycle offers a clear warning. The Portuguese real held its global influence for roughly 8 decades. The Dutch guilder lasted a similar length. The British pound remained dominant for just over a century before entering its decline. Each of these currencies rose, peaked, and faded within a span of about 80 to 110 years. The dollar entered its global role in the mid-20th century, placing it at a comparable age to previous reserve currencies. The same signals seen in earlier transitions now appear in the modern system, from persistent deficits to rising currency creation and declining confidence abroad. These indicators suggest that the dollar is no longer in its peak phases, but in the later stages of the cycle. What makes the current moment distinct is scale. Earlier transitions affected specific regions or limited groups of trading nations. When the real collapsed, its consequences were significant but localized. When the guilder lost its position, the change mattered primarily within European commercial networks. When the pound declined, the shift affected Britain and parts of its empire most directly. The dollar is different. It is integrated into nearly every global financial structure. Commodities, trade settlements, foreign reserves, and international loans rely on it. A transition away from the dollar would therefore create far broader disruptions than any previous shift in reserve currency history. This does not imply immediate collapse or sudden catastrophe. These transitions unfold gradually, then accelerate when confidence slips past a critical point. The timeline is uncertain. It may take years or decades for the full transformation to manifest. What remains consistent across history is that once the later phases begin, the earlier conditions never return. Nations do not regain long-term surpluses after decades of deficits. They do not restore unchallenged confidence once dilution has become a structural policy. The movement toward a new global reserve currency may be slow, but it is also steady. For individuals, businesses, and governments, the lesson is preparation. Holding all wealth in a currency entering its later phases has proven risky in every recorded example. Diversifying into assets that maintain value across monetary systems, productive enterprises, land, commodities, and other real assets provides stability during transitions. Observing signs such as declining reserve holdings, shifts in trade settlement practices, and increased reliance on alternative stores of value can help anticipate the pace of change. The objective is not to abandon the current currency entirely, but to balance exposure as the global landscape evolves. The pattern of reserve currency cycles is not driven by chance. It stems from structural incentives, political pressures, and economic realities that repeat regardless of era. Recognizing this pattern allows people to navigate the transition with clarity rather than fear. With this final section, the full script closes, completing the sequence of 10 parts as requested.